Hey guys, hang on. Let me push the camera back here. Tim Melvin here. Welcome to Hidden Profits Report. Boy, are we disorganized this afternoon. Uh, this, of course, will come out on September 9th, 2020, September 12th, 2023. I'm filming it on September 11th, 2023. Been a crazy day. Hopefully, you get this sometime tomorrow because I probably should have this done over the weekend. But it was my wedding anniversary, 13 years without her killing me in my sleep. It's a tremendous cause to celebrate. We went to a place off the west coast of Florida, coolest place that we've ever stayed on the west coast. Cell phone reception was horrid. The internet was ridiculously bad. I'm talking maybe 1999 bad. It wasn't good. So we had very little connection to the outside world. So I did zero work, which was a very nice change for a lovely anniversary weekend. And been just playing catch up all day today. Want to get this ready. And I know that the guys that do all the production and all, they're going to be mad at me. So sorry, guys. Anyway, guys, I want to follow up on an earlier theme of learning to love toxic. Let's just talk about where we are right now in the markets and in the world. The markets are super extended. The um, NASDAQ 100 has led the way higher, up well over 30%. The NASDAQ's up quite a bit, about 16%. But remember something, if you back out seven stocks, we're back down into the single digit returns, somewhere around 4%, according to the numbers I saw from Arnott Research the other day. Wildly overvalued, 25 times earnings on the S&P 500, which is ridiculously high. Go back and look at a chart of the S&P 500. We came down off of the highs because we were over 30 and have moved back up to 25. So it's lower than it was, at the beginning of the year, but that doesn't make it a bargain. Look at a long-term chart. Nothing really good has ever happened to returns the next few years after a 25 PE multiple on the S&P 500. If we look at the CAPE ratio, that's over 30. And guys, nothing good has ever happened to long-term returns when the CAPE PE ratio is over 30. Generally speaking, not only has the next year not been great, we're talking the next decade has usually been awful. Right now, we're projecting a maybe a 2% return for stocks long term going forward, and that includes dividends, which implies a scratch year. Okay. Now, I'm not going to say that I know exactly how a bad year is going to happen or a bad decade. It could go up and come back down. It could crash and come back up. It could just go sideways, which, believe it or not, is the worst outcome because the boredom stretches out and just year after year of grinding no returns. But the last time CAPE yields were at this level, 1969 and 2000. Let's talk about those periods that were valuations and the excess yield, that's the earnings yield compared to bond yields, of the CAPE cyclically adjusted, 10-year average earnings adjusted for inflation. Last time we had readings this low for the CAPE excess yield was 1969 and 2000. 1969, super low unemployment rates, really strong jobs market, lots of confidence that we were getting ready to go into an extended period of growth. Stocks trading at very high levels. How did that end up? Not good. As a matter of fact, next couple of years for stocks held on, then boom, everything blew up in a nasty bear market in 1972. So, and if you go out from 1969 to 1979, it just wasn't great. It was a very tumultuous decade. And unless you were some of the deep value guys, like the guys at Tweedy Brown or Warren Buffett, and you had the intestinal fortitude to step up and to buy into disastrous sell-offs that went further after you bought in most of the time, you didn't make any money in the 1970s. Now, some people did, most people didn't. Flash forward the next period, 2000. Okay, about this time, September 2000, everybody's thrilled, right? The Fed is done raising rates. We're going to have a soft landing. The economy is going to be great. Stocks are super extended because there's something new in the world, the internet. and it's changing everything about work, about recreation, about how we communicate, about how we stay in contact, how we view entertainment. Everything's going to change because of the internet. So multiples don't matter. And then all of a sudden, they mattered. Those earnings estimates that have been going up throughout the first part of 2000, driving stock prices to very high returns in the Nasdaq and okay returns in the S&P 500. Sound familiar? Because it should. Those earnings started to decline, and the estimates started to fall rapidly. And stocks, yeah, all the air came out of that particular room, and we ended up with a decade where investors basically broke even. By the way, 1969, going back to that, if you bought that high in 1968 or into the market in 1969, you didn't break even, folks, till 1982. That's a long time to wait to recover your losses. Am I suggesting that's not going to is that that's exactly what's going to happen again? Only sort of. I do think that long-term returns from here are going to be terrible. I just don't know what path they're going to take. I'm highly confident that if you buy into the theory that's being tossed around that AI is going to change everything because, and so earnings don't matter and multiples don't matter, then I think you're going to see the same result that internet investors saw in 2000. The internet did change everything. I've talked about this a lot. It changed the way we communicate. It changed how we view entertainment, the way we watch TV. Excuse me. The way we learn, the way we educate our kids. It changed everything. Changed the way we work. Think about your life in 2000 and the usage of the internet compared to today. It's night and day. It's a different world. And that was because of the internet. However, if you bought the very best internet companies back then, you broke even in 2016, 2017. And I'm talking the Microsofts, okay? If you bought the all story, no profits, you never broke even because they just collapsed and they went away. That's exactly what's going to happen here. I think that if you look at the Googles, the Apples, the Microsofts today, they're very expensive. They could well go down quite a bit, but you go out a decade, you're going to recover, all right? And they're going to dominate the space. And artificial intelligence is going to change everything. It's going to change industries, some for the better, some for the worst. It's going to change the way we communicate. It's going to change almost everything about the world that we live in. However, it's too high a price for everything, and we're there. So what do? Let's kind of look at the world following these extreme valuation peaks of 1969, of 2000. Where were the smart plays? Real estate, 100% real estate. And by the way, what are the three most out of favor industries right now? Utilities, real estate, and banks. Okay, so let's kind of look at that. If you had owned real estate in 1970s, you just kicked the stock market's butt. REITs came into their own. The industry was redefined by Sam Zell in 1972 and was like a launching pad. And of course, inflation kicked real estate even higher. Smaller banks was a rough path, but most of them did well. If you go back and you looked at the thrift indexes, they did pretty well because there was tons of thrift conversions back in those days, and those have done extremely well, even more in the 80s, but that's another movie. Now, if we go back and we look to more recent, the 2000s, what worked? REITs. As the markets were collapsing in 2000, 2001, 2002, 2003, REITs did fantastically well. If you look at that lost index, that lost decade, the indexes lost money, a little bit of money. The S&L Thrift Index almost tripled. Okay, so small banks, REITs did extremely well. What else did well? In both the 1970s and the 2000s, example, fixed income crushed stocks, providing, in many cases, double-digit returns depending on security selection and sector and that sort of thing. Even if you just bought straight out government bonds, you kicked the stock market's butt. So why do I bring this up? Well, where are our publications positioned? Well, obviously, 20% letter is all about REITs, and banks for the most part. We're going to be doing some other cool stuff with that, but it's also stuff that has historically done well during periods of bad markets. That should be coming up later this month, as a matter of fact. So REITs and banks, we got that covered, and we've got them on sale at a time when everybody hates them. They're toxic. Wall Street can't stand them. The media hates them. Financial publishing, my industry, all just thinks they're garbage. Great time to be a buyer of banks and REITs. The valuations are stupid, the dividends are high, and patient aggressive investors are going to make a ton of money. Fixed income, this is actually a historic buying opportunity for fixed income. We've had one of the most rapid increases in Fed fund rates ever. We've gone from 0 to over 5.5 in the blink of an eye. There may or may not be one more hike ahead, but we're almost done this cycle. Okay. We are far closer to the end of the rate hike cycle than the beginning. Now, whether rates plateau or we begin to see cuts because the economy has slowed down dramatically later this year, early next year, which is what I think is going to happen. Say I'm wrong and they just stay up here for longer. There's a tremendous amount of money to be made in select corporate bonds and preferred stocks. I'm talking double-digit rates of return from very low risk investments, even as the stock market crumbles from its very high, rather lofty levels. So banks, REITs, fixed income, utilities, I love utilities and they have been beaten up, but keep in mind, rates have been so long for so low, and they are interest sensitive, that they're falling from very high levels. They're only down about 10% over the last year. I think they may have a way to go. We own one in the MVP portfolio, and our rule in utilities is simple. And I would have to really go back all the way to the 80s to pull up trading records. So I'll just say I'm pretty sure that I've never lost money in electric utility security. I don't recall it ever happening. Going back since I've been making public recommendations, I could say with a high degree of confidence, no losers in utilities. Simple reason, we never pay over book value. We just absolutely won't do that. And we've bought utility preferreds, and we'll pay under 80% of par, generally speaking, and it's just always worked out for us. We've even bought bankrupt utilities, and that worked out. All of those worked. That was back in the 80s. It was a lot of fun. You had cost overruns on utilities. Long story. Everybody hated them. If you understood even basic math and applied it to the situation, it was clear there was an enormous amount of money to be made. Try cold calling with that sometime, by the way. That was a lot of fun. So anyway, those are the toxic areas. They're exactly the areas we want to be. Bonds are getting crushed. Everybody hates it. Let's buy them. Everybody hates REITs. Let's start buying them. Banks, we're all in on banks and think you ought to be as well. So anyway, guys, that's Hidden Profits for September 12th, 2023. We'll have some more for you coming up on Thursday. Jay Soloff and I are going to get together and we're going to talk about some ideas and some things that we do differently that we think you ought to be doing too. Be aware right now, guys, the biggest opportunities are in Europe. And I am told that in my industry, financial publishing, we should never talk about Europe because it doesn't sell. Nobody likes it. They only want the U.S. opportunities, and they want to make all the money right now. Well, you're not going to make all the money right now. I'm sorry. Now, you can make a lot of money if you'll do everything differently than everybody else is doing and do the things they tell you not to do. Let's double down on the hatred. Let's buy banks, REITs, and utilities in Europe because they're really, really cheap. And Europe will recover from the current levels. And when they do, extraordinary amounts of money will be made. So stay tuned. We'll name names and throw some ideas out there as time goes by. But for right now, if you're hunting for stocks, you need to be in REITs, banks, a little bit nibbling on utilities. And the massive opportunity right now is in fixed income. So if you're not a member of 20% Letter and Underground Income, go check them out, guys, at investorsalley.com. I think you'll be pleased that you did. Anyway, thanks for watching, guys. We'll talk again on Thursday.